Welcome to Turbo Impact, where we navigate sustainability in private capital. I am your host, Kenny Chen. Each episode, we sit down with investors, allocators, and corporate leaders shaping the next era of sustainability. We explore how capital is driving the global transition and how today's decisions are shaping the future of impact. Thank you for joining us. This podcast is brought to you by Turbo Net Zero, a pure-play sustainability advisory firm driving impact across the private markets. Hi, Ben. Welcome to Turbo Impact Podcast.
Hi, Kenny. Thank you so much for having me. It's great to be with you.
Can you start by telling us about your role at BCG?
Yeah, absolutely. So I'm Ben Morley. I'm a partner and director at BCG. I'm based in our Boston office, and I do all of my work at the intersection of our climate sustainability, social impact, and private capital practices. So I'm doing a lot of work advising private equity funds, private capital funds on kind of related topics. One of the hats I know particularly relevant for this conversation is that I lead BCG's support of the ESG Data Convergence Initiative, or EDCI. I've been doing that since its inception back in 2021, 2022, and it's been a fantastic journey.
Take us back to the start of EDCI. What was the moment when you and the GP/LP steering committee realized the market needed convergence?
Absolutely, yeah. So for those not familiar, the EDCI, I think it's really been this amazing story of industry collaboration addressing a shared collective action problem. So if you wind back to 2021, there are a number of GPs and LPs, kind of GPs led by Carlyle on the GP side, and on the LP side led by CalPERS, the California Pension Fund. And they were really grappling with this thorny issue around sustainability data. There was a real focus on improving quality of data, both in the public markets and in the private markets. And I think a number of these large LPs were allocating capital to the private markets. They were increasingly making data requests of the managers that they're allocating capital to. Now, the challenge is, though, that if you're the head of sustainability at one of these private equity funds, suddenly you're getting lots of different data requests coming to you from different directions, different formats, templates, definitions. Essentially, it's this classic collective action problem. I know some of the GPs I was talking to at the time, they were saying we're spending more time working on these data requests than we are on actually thinking about sustainable value creation. So it's really kind of a big issue here. And what this small group of GPs and LPs identified was the opportunity to drive industry alignment around, okay, let's develop a small set of metrics that all of us can commit to collecting from our portfolio companies and sharing through to the limited partners to provide that line of sight across the investment value chain. So BCG we were supporting those working sessions. We were helping with the brainstorming. What could that small set of metrics be? What are the LPs looking for? What are GPs able to collect? And that was around, so that kind of working through those sessions, we developed a short list of metrics. We developed some metrics guidance. We developed a template for GPs to be able to kind of collect that data from their portfolio companies. And then the founding members, those GPs and LPs, they made it open source. They said, anyone that wants to join us on this journey would be delighted to have you. So we've gone from a world in which I think it was probably 15, 16 organizations at its inception. We've now got over 500 investors around the world that have signed on to this initiative. Those founding investors have become the steering committee of the initiative and kind of provide leadership on behalf of the industry. And I know that of those 500 investors, over 10% and growing are now from Asia Pacific. So kind of it's truly we're looking at kind of all regions of the world, or all industries are kind of covered by the EDCI.
I have to say, amazing journey so far. And when you say convergence, what particular design choices you think made it workable for both GPs, LPs, and so many portfolio companies to adopt?
Yeah, absolutely. So that was actually where we started. We didn't start with a list of metrics. We started with a set of principles around what those metrics should be. So I think a few of the aspects were we wanted to be a really short list. It needs to be a focused list. It needs to be accessible to investors. The metrics need to be globally relevant. They need to be applicable to you, whether you're a kind of software investor in the United States, a chemicals investor in Europe, or a kind of retail in Southeast Asia. Like it needed to be something that any company would be able to look at and say, yeah, these metrics are relevant to me. They need to be straightforward to understand, kind of easily understood and interpreted. They need to be meaningful from a commercial and a societal perspective. They need to be things that GPs, we knew we'd be successful if GPs would look at the list and say, absolutely, we need to understand these metrics in order to build stronger businesses. Like these are important elements of what it means to be a good business in the 2020s. And I think another really important element to this was these metrics were chosen by the industry for the industry. The GPs and LPs are the ones themselves that decide which metrics get included. And there's a very structured process to add new metrics. So since the inception of the initiative, where we had 6 key metrics, over time we've actually added two more. So every year we gather feedback from all EDCI members. We ask what's working well, what challenges are you experiencing, how would you like to evolve these metrics in any way? And over time we've added a new net zero metric and a new cybersecurity metric. So net zero metric was made, I think, back in 23 for the 24 edition, and the cybersecurity metric was added last year for the 2026 edition of this initiative. So if I think about the net zero, it was a very thoughtful process. Like we formed a working group, we brought together GPs and LPs, we engaged with other industry associations like ICI and IIGCC on the different frameworks that were in place. And then we came up with a short list of 3 questions. So do you have a decarbonization strategy? Do you have an emissions reduction target in the near term? And do you have a long-term ambition to be net zero by 2050 or sooner? There's a few multiple choices for each of those questions, but I think you get the sense of, okay, these questions they're meaningful, they're easy to understand, they're accessible for companies, irrespective of where they may be on their net zero journey.
And given that you work closely with these many private market investors, what are your observations on how private markets are driving sustainability? Are there any notable trends starting to emerge?
Yeah, absolutely. I think this is a really exciting part of BCG's role supporting this initiative. So every year we actually publish a report. We say, okay, this year think about 2025, we had over 500 GPs and LPs contribute over 230,000 data points for 9,000 companies. So now you've got this data for the first time. You have this large data set of sustainability insights about the private markets. And we analyze that and we kind of share back key trends with EDCI members. So if I think about last year, what were the key things that came out? Firstly, I would say, if you look at snapshot performance of sustainability in the private markets, well, private companies are leading on some metrics relative to the public markets, and they're lagging on others. So if I think about some metric like job creation, so private companies, systematically, over the time we've been supporting the EDCI, we see private companies creating jobs at a faster rate than what we observe in the public markets. That's true across industries, it's true across regions. And I think it speaks to a very different role that the private capital industry is playing in the 2020s, and the kind of the opportunity for driving growth, driving economic growth, and seeing that benefits more broadly. But there are certainly areas where private markets are lagging. So if I think about renewable energy usage, we see on average that the average private company is using significantly less renewable energy than the typical public company. So again, just the snapshot performance, some areas of outperformance, some more challenging areas. I think the second learning we have is that actually, as we look across the whole period, when you look at if you think about the private equity investment model, private equity excels at taking kind of unloved, neglected businesses, kind of working with management teams to hone their commercial model, and then driving progress over the course of a 5 to 6 year time horizon. That's exactly what we see in the sustainability data in the data set as well. For those companies that have recently been acquired, maybe they're kind of relatively immature, maybe they don't have much data yet. The data that they do have relatively low performing, but over the duration, by the time it's kind of been owned for 4, 5, 6 years, we're seeing pick your metric, whether it's renewable energy usage, injuries, diversity, we're seeing real progress and kind of and stronger performance across those metrics. And so I think that's those are kind of the key themes that are coming out from us. I think excitingly, we're about to begin the process of collecting data for 2026. And as every year we've been doing this initiative, we develop a richer data set with more trending data, and we develop kind of more confidence in these findings.
As EDCI has scaled over the past few years, what has been your proudest moment so far? And where do you see the biggest friction that still needs to evolve next?
Yeah, so I think for me, it's really about seeing that vision that the early founders of the EDCI had that was so kind of inspiring, seeing that really come to fruition at a global scale, and to being able to play a role in really supporting them and enabling that to happen. Kind of as I kind of travel around, I sit down with investors all over the world, and it's so powerful to hear stories from them about how their firm is engaging with it, the problems it's solving for them, the way in which they're using the insights from the data that it's unlocking. So, I mean, to give you an example, the decarbonization metric that I mentioned earlier, the net zero, those three questions, it was the EDCI working group that developed those questions, and now a few years later, we have real data that people are using to make decisions from. So, I mean, to give you, if I think about the decarbonization strategy question, we know that private companies have about 25% of private companies have a strategy, decarbonization strategy. That compares to about 35% in the public markets. So somewhat lower than what we see in the public markets. But we do know, and we can see this in the data, that those private companies with those strategies, they're decarbonizing faster. They are seeing kind of apples to apples, lower levels of scope 1, lower levels of scope 2 year over year relative to what you might observe in the public markets. And that's really underpinned by, as I think about the progress that private companies show over time, at inception, at ownership, at kind of initial ownership, typically about 10% of energy is coming from renewable sources. By 4 or 5 years into the whole period, that's now up to 17% in renewables. So these kind of insights are kind of so rewarding to be able to see. And it's not just on the kind of emission side, on the environmental side. We also have really powerful insights on the social side. So again, you go from early days of the initiative. I think the first time we ran the analysis, 58% of portfolio companies were saying, we do an employee survey on a regular basis. That's now up to 74%. In just a handful of years, we're seeing real progress in the amount of and how these companies are engaging with their employee base. And in my conversation with GPs, I know this is a particular focus that they're engaging with. They're thinking about the employee value proposition and things like injuries and kind of how people are experiencing the workplace and how they can connect that to commercial and financial performance. And that's where I think we've made so much progress so far on kind of just understanding this data. That for me is that next horizon around kind of how do we take these data sets, how do we correlate, clearly kind of link it to financial performance and really kind of work through those methodologies and work through those insights about the mechanisms through which making progress on sustainability drives commercial value creation.
And what best practices have you seen to secure real portfolio company buy-in? And how does that translate sustainability data into tangible value creation?
Yeah. I mean, I think let's get back to what I was saying earlier around when GPs and portfolio companies are looking at these metrics and say, okay, I understand how understanding this data connects to building stronger businesses. Like, how do you link these metrics to commercial outcomes, to building those thriving enterprises? And the EDCI, we're making progress on that. So in 2025, we actually instituted a commercial outcomes working group. And it's been the best attended working group the initiative has ever had. I think we had over 70 GPs and LPs be part of that work. And we started off by asking those GPs, okay, as you think about sustainability and the initiatives that you have in flight at your portfolio companies, what's the order of magnitude of impact that's going to have on EBITDA over the lifetime of the whole period? And the feedback we got back was somewhere between 4 and 7 percentage points improvement on EBITDA. And that's a relatively even split between cost reduction and revenue growth. Now, that's a weighted average. There were plenty of GPs that had lower levels, plenty of GPs that had significantly higher levels. But on average, we're talking about quite a meaningful profitability improvement over the duration of the whole period. And I think what's really fascinating is then, okay, let's talk to those GPs that say that sustainability is particularly important to their investment thesis. Like it's a real kind of real driver of our ability to create value at our portfolio companies. And then talk to them about their EDCI outcomes. And we see that they're not just talking the talk, they're actually walking the walk. So to give you, I could choose any of the EDCI metrics, but to give you a couple of examples, on the renewable energy side, those GPs, they have actually 21 percentage points higher levels of renewable energy. So 21 percentage points higher of their energy coming from renewable sources. And that's because they're looking at this and they're looking, okay, where are the abatement curves? What are the abatement levers that I can pull? How do I drive decarbonization in ways that create value? They're thinking strategically about their energy mix. How do they procure lower cost, more secure energy? I mean, you look at what's going on in the world in 2026, and you can just see how critical some of these aspects around energy security and reliability are to business success. And that's just on the cost side. You've also got on the kind of on the revenue side, increasingly in supply chains around the world, procurement and emissions are becoming more central to procurement decisions. So again, leading on this space positions you well with that customer base. To flip back over to the social side, those same GPs, they're actually saying that if you look at their employee turnover levels, their employee turnovers are 5 percentage points lower than the average in the EDCI data set. And again, we're hearing from those GPs that they're putting a real focus on the employee experience. There's a social case for this, that you're kind of delivering social, like having social impact through engaging with your employees. There's also a business case from having happy, productive employees. So again, there's cost and revenue aspects to this. On the cost saving side, every time you lose an employee, well, you now have to hire a replacement. There's costs associated with that turnover, kind of hiring, training, getting them up to being as productive as their previous employee. And then on the revenue side, we actually see that in the EDCI data that there's a correlation between those companies that have more satisfied employees and those companies that are growing rapidly, have high levels of revenue growth. There's going to be some correlation both ways, because it's certainly true that when you have a company that's growing fast, they're going to be creating great opportunities for their employees. But it's also certainly true that when employees turn up and they're motivated, engaged, and ready to be at work, they're going to be contributing towards the success of that business. Some GPs that we're in dialogue with, they actually estimate the value at stake from both of those kind of elements, the cost and the revenue side, is in the order of magnitude of 50% of an employee's salary. So if you can hang on to that employee and retain that employee, there's really profound benefits in terms of avoided costs and retained productivity. So I think on both the environmental and the social side, when you actually start digging in with leaders in this space, the value becomes very tangible kind of very, very quickly.
What trends do you think private markets should be taking seriously right now? And where do you see the next convergence areas emerging?
Yeah, I think that's a great question. I mean, so from the EDCI's perspective, the focus on employee value proposition and deepening our understanding about that and the mechanisms through which kind of exactly how that translates into stronger business outcomes. I think that's a really interesting space, particularly in an age of significant change with rapid growth in AI and how that will impact workforces. So I think that's a really interesting trend that we want to continue to advance research around. I'm also really interested in the learnings we're going to have from the EDCI's new cybersecurity metric. So we've added this new cybersecurity metric for 2026. There's a lot of questions around cybersecurity testing. So are you doing penetration tests? Are you doing vulnerability scans, etc.? So I think, again, connecting it to AI, with cyber threats getting more sophisticated, this is really top of mind for a number of portfolio companies, for a number of GPs. It's going to be increasingly important to value preservation, how you manage those threats, and how you kind of put in place some of these kind of testing best practices. I think continue the conversation about AI. I think there's a big focus in the private markets right now about how do we harness AI to create value in our portfolio companies. And there's also a really important sustainability question about the guardrails you're putting in place around responsible AI. So how can private companies capture value from AI while minimizing the risks that they're exposed to? And we know those risks, they're moving fast, they're complex, they're hard to navigate, whether they're kind of hallucinations, IP leakage, bias, regulatory changes around the world. It really requires new disciplines, new muscles, and implementing them quickly, given the pace of change. So how are private equity funds navigating these topics? Decarbonization, employee experience, cybersecurity, responsible AI. I think those that are navigating those risks and pursuing those opportunities are those that are going to protect and create value in a rapidly changing world.
Final question to you, Ben. I ask every guest this. What do you think is the most effective way to turbo impact in your field?
Yeah, so it's a great question. I think as I think about this, for me, it's a lot about moving away from just collecting data or collecting case studies, and actually kind of using that data and generating insights and integrating into value creation plans and driving change. So we now have, as an industry, this open benchmark of 9,000 portfolio companies, 230,000 data points. Every private equity fund is able to kind of put in context their own portfolios within the broader private markets and identify those metrics, those topics where they are doing well, and they can kind of celebrate the progress that they've made so far, but also where maybe there's kind of a gap to some of their peers and opportunities for them to focus and over the duration of the whole period, do what private markets firms do so well and kind of driving that progress and creating that value. So I think for me, the most effective way to turbo impact is to take that data that you're collecting, interpret it, and then kind of integrate it into your value creation plans.
Thank you, Ben. And as a private market practitioner, we thank you for your transformative leadership in the private market space. And from our experience, EDCI has not only converging the data, but effectively converging the global private markets together. And thank you again for your time and joining Turbo Impact Podcast.
Thank you so much, Kenny. It's been a pleasure to be joining you and to be discussing these topics with Turbo Impact. I would just say, like, this is BCG. We're delighted to be supporting. I think we're really really impressed with the quality of the progress that the private markets has been achieving in this dimension, and it's been a real honor to be supporting all the GPs and LPs that EDCI members in enabling that.
Thank you, Ben.